Hi, I'm Miles Espy, a CPA with Drafton & Tucker, and I want to take a few minutes to talk with you today about the importance of adequate planning anytime that you're buying or selling an interest in a closely held business. Closely held businesses are bought and sold almost every day. However, the typical business owner may only sell or buy a business once or twice during the course of their entire career, if they ever do at all. As a result, a business person runs the risk of missing a lot of important details that could have important long-term and short-term effects if the transaction is not structured properly. So it's very important to get proper guidance as you're going through these transactions. The most basic element of a sale, of a potential sale of a closely held business or the acquisition of a closely held business is, what is the subject of the transaction? Is the stock or actual interest in the company being acquired? Or, by contrast, are we buying or selling the underlying assets of the company? You know, what I found is, in my career, is there's been several instances where I've spoken with parties who've actually agreed to a purchase price, yet they can't answer that basic question: what is actually being bought or sold? And the differences between those two can be profound. So it's very important before you settle on a price that you know how the transaction is to be structured. So let's spend a little bit of time talking about the differences in these two scenarios. In the first scenario, where the stock or owner interest is being sold, the seller will pay income taxes on the gain from the sale of the transaction. That gain is likely to be a capital gain, which will be subject to capital gains rates, which are typically lower than ordinary income tax rates for an individual. In contrast, the purchaser under this scenario, without effective tax planning, will not receive a step up in the basis of the underlying assets of the business enterprise. In other words, the basis is going into the stock or the interest in an LLC or partnership, whatever the case may be, and the underlying assets within that entity remain the same after the transaction as they were before the transaction. So the purchaser is losing opportunities to be able to deduct depreciation and amortization that he might get if he or she had a stepped up basis there. In the second scenario, where the underlying assets are being purchased, the seller may be subject to some ordinary income tax rates rather than capital gains rates on some portion of the gain. If the business being sold is a corporation, we've got bigger problems. The seller may even be subject to double taxation, as the corporation pays income taxes on the gain of the sale of the assets, and then as cash is then transferred out to the owner to close down the old operations, then there's another tax that's being paid by the individual in that scenario. Obviously, this scenario is less attractive to the seller. However, in this scenario, the purchaser, now they are able to get that stepped up basis in the underlying assets that they didn't get before. And this is going to result in some additional depreciation and amortization deductions they'll have against taxable income, which is certainly of significant value to the purchaser. So you can see in looking at these transactions here, the difference in those two, the structure of those transactions, they have different values to the buyer and the seller. So it's important that that structure be worked out in agreeing to the purchase price. Let me talk a little bit about the sale or purchase of assets, because that is another area, again, that many of our clients need guidance on when they're going through these types of transactions. Once the two parties have agreed to an asset purchase, the purchase price must then be allocated to the underlying assets. This is extremely important to both parties, as it will impact the income tax reporting of the transaction for each party, as well as the financial statements of the ongoing business. Since many purchases may include goodwill, it's important that these parties seek the advice of accounting and tax professionals who can advise them regarding these allocations, because, once again, they can really impact deductions that are being taken on the return. Additionally, there are special elections that can be made in some instances in the acquisition of a business. These special elections sometimes can allow one party to achieve the results they desire and the other party receive the results they desire that may not mesh well together otherwise. So it's very important that you seek good counsel that has an idea of what these special elections really are. And I'd like to encourage you to feel free to contact me or any professional with Drafton & Tucker if we can assist you with tax planning associated with either the acquisition of a closely held business or the sale of your closely held business.